Welcome to Dinar Current, your reliable destination for deep dive analysis and intelligent perspectives on currency movements often ignored by conventional media. What unfolded today in the global foreign exchange (FX) arena wasn't a random anomaly or a glitch in the system. It was a precise, deliberate, and potentially game-changing move. The focus: the Vietnamese Dong (VND). This was not a case of financial panic or accidental volatility. It was, as some experts are now describing it, a coordinated ignition. This isn't a collapse narrative. It's a reset. At exactly 8 a.m. Greenwich Mean Time, an orchestrated disruption began. FX platforms in major trading centers, London, Frankfurt, New York, and Singapore, simultaneously experienced sudden freezes. Initially, traders chalked it up to technical issues. But it wasn't long before they realized the truth. The trading infrastructure wasn't failing, it was reacting. The catalyst was massive, targeted buying of the Vietnamese Dong. Automated systems were overwhelmed. Algorithms failed to compensate. Circuit breakers tripped. Entire trading networks temporarily shut down. This was no ordinary price surge. It was a flood of high-volume activity, clearly structured, and executed with clockwork precision. Behind the scenes, major financial institutions received internal notices. No commentary on the Vietnamese Dong. No public statements. No internal analysis. Silence. A full blackout. Why? Because this wasn't accidental, it was planned. The trades were tightly timed, highly resourced, and carried out by major players, likely with privileged access or unofficial green lights from top-tier regulators. Not long after, leaks from within Vietnam's Ministry of Finance surfaced, detailing a long-prepared revaluation initiative for the VND. These confidential files outlined a phased currency revaluation model, strategic alignment with BRICS trading policies, reinforced gold reserves, private financial agreements with global economic powers. This wasn't speculative theory. It was an operational plan more than 10 years in the making, now executed at a moment of maximum global market overlap. Why now? Because this was a stress test, a deliberate probe to see which systems would buckle and who would benefit. Insiders moved first. Retail investors and smaller institutions were left scrambling behind. Following the initial shock, unusual VND exchange rates started surfacing. Some trading dashboards showed rates as low as 150 or even 1,500 dong to the US dollar, a dramatic deviation from the usual 23,000. Official FX tickers didn't budge, but alternative platforms told a much different story. Domestic banks in Vietnam reacted fast. They pulled rate quotes, halted transactions, and shut down branch-level FX services in major cities. The State Bank of Vietnam reportedly enacted emergency procedures, tightened security, and held unannounced high-level meetings. This wasn't a meltdown. It was a managed ignition. A sign of preparation, not panic. Was this a standalone event? Unlikely. Growing consensus among financial strategists points to something broader, the start of a new currency cycle. A shift in how undervalued currencies are treated on the world stage. The VND may have just served as the pilot for a series of revaluations among emerging market currencies. 2025 could go down in history as the year Vietnam evolved from a regional manufacturing hub to a major player in global finance. If the VND's new valuation stabilizes, neighboring countries, including Indonesia, Thailand, Malaysia, and Laos, may be forced to respond, reevaluating their own currency policies to stay competitive. This wave will ripple outward. Multinational CFOs will be forced to reassess supply chain contracts and hedging strategies. And lurking beneath it all, the potential unraveling of complex derivatives contracts tied to undervalued currencies, a financial time bomb. But perhaps the biggest transformation is psychological. For decades, the concept of a global currency reset (GCR) was relegated to conspiracy forums and fringe thinkers. Financial elites mocked the idea. Economists dismissed it. Today, many of those same voices are reconsidering. What we've just witnessed with the VND wasn't a rumor. It was a strategic maneuver. A real-world deployment of financial leverage and institutional coordination. So, what should VND holders do now? Secure your holdings, keep physical currency in protected, sealed containers. Document everything: receipts, origin records, exchange slips. Stay compliant, Know Your Customer (KYC) and anti-money laundering (AML) rules may tighten rapidly. Watch for silent pauses. Some private dealers have already frozen VND redemptions pending regulatory changes. Follow coded language. Terms like currency harmonization or stability review often hint at deeper revaluation activity. Be cautious of private offers. Some non-disclosure agreement (NDA)-based deals may be legitimate, but many are traps. This isn't just about Vietnam anymore. It's potentially the start of a new global monetary realignment. If the VND move proves successful, others may follow. Iraq, Iran, African and Latin American nations aligned with BRICS+. You won't see headlines. There won't be breaking news banners. You have to recognize the signs. Preparation is everything. At Dinar Current, we're committed to tracking these unfolding dynamics, not just reporting, but decoding them. While the mainstream media keeps quiet, we analyze the patterns, monitor the whispers, and deliver the insights that matter. What happened today is not the conclusion. It's the first spark in a much larger financial recalibration. And if you're paying attention, you still have time. Stay informed, stay proactive, and stay ready. 2025 is shaping up to be the year the monetary order begins to shift, and Vietnam is leading the charge.